So we're going to start in Chapter 3, kind of as an overview of Chapter 3 and assets, liabilities, and those kind of things. Okay? So if you have your book, we're going to do the expanded equation, the expanded accounting equation. Okay, and it's on page 87. Okay? So the accounting equation is kind of set up in the form of a balance sheet. Okay? So the original accounting equation is set up in the form of a balance sheet. And the balance sheet is one of the 4 financial statements. So do you guys know what the balance sheet, what's on the balance sheet? What things are on the balance sheet? Assets. Okay. So that's kind of how the accounting equation starts out. We have assets equals what? Liabilities plus stockholders' equity. Okay. So stockholders' equity, owner's equity, equity, right? Stockholders' equity would be for a corporation. Owner's equity would be for a, sole proprietorship. So on this, all of this stuff right here, this is the balance sheet. That's what a balance sheet looks like, right? Those two things are equal, okay? Now, let's just stop it right there. That's kind of the basic accounting equation. So let's talk about those accounts and what type accounts they are, okay? So let's think about assets, what assets are, some examples of assets, and like debit and credit issues with assets, okay? So debits and credits. Let's just think about debits and credits for a minute. Debits mean, what do debits mean anyway? Okay, it's really simple, right? This is a simple answer, but sometimes you might not think of it like this. Really, debit means which side, left or right? Left, okay? So debit really just means left. And credit just literally means right, okay? So assets, any kind of asset, if we think of it like a T account, assets increase with a debit. That's what assets do. So if you get more cash, you're going to debit cash. They increase with debits, and they decrease with credits. Okay, so you understand how this T account works. Debits are on the left, credits are on the right. Assets increase with debits. Okay, so we can say assets we can think of as debits. In general, their most common form is debits. Okay? So this equals that. What would you think liabilities and stockholders' equity are if assets are debits? These other guys on the other side of the equal sign are credits. Right. These guys are credits, which means that liabilities increase with a credit. Okay? And also, stockholders' equity increases with a credit. Okay, so are we good so far? Now we have on the left side assets that are debits. Doesn't that make good sense? Debit means left. Assets are on the left side. Okay? Credit means right. Liabilities and stockholders' equity are on the right side. So that's kind of how you can remember what things increase with debits and what things increase with credits. Okay? All right, so now we're going to think about what are some different kind of assets. Okay? This is one thing that we're going to be doing throughout the semester is to try to learn what accounts, are they an asset or a liability? Are they on a balance sheet or an income statement? Do they increase with a debit or a credit? These are important things. So for every account, you need to know, Is it commonly a debit or a credit? Is it on the income statement or the balance sheet? What else did I say? Anyway, those are the kind of things, all right? So we want to come up with a list of assets. This is not the last time we're going to do this exercise. As a matter of fact, you're going to have like homework regarding this, a quiz regarding this. This is going to be on the test regarding this, okay? So assets, what kind of assets can you think of? Earlier, I talked about two cash and prepaid expenses. Okay. Who said that? Property. Okay. So this, who else has an asset? Not you guys. More assets. No? No more? Inventory. Excellent. Okay. What else? Nothing? Accounts receivable. Okay. Yeah, that's a good one. All right. So we've kind of got a lot of assets. As a matter of fact, these are kind of maybe some of the most common assets. Now, if you say to yourself, oh my goodness, there's got to be more, you could look at the back of your book on page, well, not the back of your book, on page 110, the back of chapter 3, they have a lot of assets listed. And let's just see what we have missed on this list. And there are two things that we've kind of missed, but I'm going to kind of call them not really assets, but they kind of are assets, okay? And they are, I want you to explain these to me. Property, okay, let's just call this property, plant, and equipment. This is a fixed asset, right? What do we do with fixed assets? The weird thing that we do with them? Depreciation. Okay, so what kind of thing like depreciation is associated with these assets? Depreciation is an expense, but there's something that's kind of like an asset. A contra asset, what is that? Contra asset associated with these guys, what's the name of that account? Accumulated depreciation, right? Okay, so accumulated depreciation is a contra asset. And what do we mean by contra asset? It normally, where the rest of these have a debit balance, contra assets have a credit balance. Okay? So like on the balance sheet, it says fixed assets or property, plant, equipment, and then we subtract accumulated depreciation from that. It appears right below the asset, and it is, okay, contra asset, opposite, opposite balance. Where assets have a debit balance, contra assets have a credit balance. And they're directly subtracted from the asset, okay? Now, there's one other contra asset, and that has to do with accounts receivable. So accounts receivable, these are the guys that owe you money. Does every single guy that owes you money pay you? No. Now you're naming for me the expense part of it, but I'm looking for the contra asset part of it. What's the other? When we make a bad debt expense entry, we debit bad debt expense and credit allowance for doubtful accounts, right? Allowance for doubtful accounts. Okay, so what is this? This is a contra asset that shows up on the balance sheet right below accounts receivable, but instead of having a debit balance like accounts receivable, it has a credit balance. Okay, now we have named, y'all have done a great job here because we've named everything on the balance sheet on page 110. So this kind of gives us a good idea that we've covered the main assets, the primary assets, and really everything else is kind of an extension of this. If you can get these assets down, you can feel really good about yourself, right? Okay, now, kind of the bad news is the assets out of this whole thing are probably the easiest one for everybody to grasp, right? Don't you think cash, if you can think of, cash as an asset, and assets are things that you like to own, things that you want to own. You want to own equipment. You want to have inventory and accounts receivable. These are positive things for you and your business, right? So liabilities, what are liabilities? Liabilities are, in general, things that you owe. So that's not such good news for you or your business, right? I guess you have to have liabilities to do business, in general. But these are kind of more negative things. And, okay, so these are credits. A lot of people get it all mixed up. What are liabilities and what are stockholders' equity? For some reason, they can remember the asset side's a debit. But, picture this accounting equation where there's an equal sign and stuff on the left and stuff on the right, okay? All right, so let's think of some liabilities. And do you guys have any liabilities? Accounts payable. Okay, so when you when you buy stuff, sometimes you don't pay in cash right away, and you instead have an accounts payable. So maybe you guys owe people money. That's what accounts payable is, if you owe money. All right, anything else? Any other liabilities? Maybe if an accounts payable is if you owe somebody money kind of on a short-term basis. What if you owe somebody money on a longer-term basis? Notes payable. So a note payable just means you signed a note. There is a piece of paper saying that you owe this money, you've signed a note. In accounts payable, it's a short-term, no note is involved. Okay, anything else? Now it gets a little bit harder. Are there some more payables? Any more payables? Besides accounts payable. What other kind of payables are there going to be? Do you guys pay rent? So, yeah, rent payable, right? Interest payable, wages payable, salaries payable. Virtually any kind of expense can turn into a payable. It's a debt that you owe, but you haven't paid yet. Okay, when's your rent due? Well, maybe that's not a good example. Let's not do that. Let's say you're way behind on your rent, and you haven't paid for 2 months, right? That's a rent payable. You owe for last month. That's a payable. You owe them, but you haven't paid it yet. Okay, so interest payable. All right, then there's another one that is kind of strange. And I could draw this out, but why don't I just write it on the board and see if you've ever heard of unearned revenue. Unearned revenue, okay? So this is a liability. See the weird thing? It says revenue in the name of the account, right? What does it have to do with revenue? Why is it unearned? And what makes it a liability? This is what we want to understand today, right? So how do we get unearned revenue? Let's say somebody pays us, here we are a business, let's say we sell shoes. Somebody pays us for shoes and we don't give them the shoes, right? Somebody pays us in advance. What kind of crazy person would pay us in advance? Well, there's all kind of reasons, right? If somebody pays you in advance for something that would ordinarily be a revenue thing, then you cannot recognize it as revenue yet. Why is that? You haven't earned it yet. Okay, to earn revenue, you need to There's a couple of rules. We're going to learn those rules, I think, in chapter 2. But, it has to be realized or realizable, and you have to have done substantially everything you need to do. Well, the problem is if you haven't given them the shoes yet, if that's the deal, you haven't fulfilled your deal. Your factory could burn down and they still don't have any shoes, right? And so you owe them the thing that they bought. And until you give it to them, it's unearned revenue. Are y'all following that? So, let's say somebody gives you cash and you give them shoes, you can call it sales revenue, right? This is your journal entry. But if somebody gives you cash and you don't give them the shoes, then you credit unearned revenue. So this is the journal entry if you have earned it, and this is the journal entry if you have not earned it. Does that make sense? So that makes that a credit. This is a liability, and what do we call this? This is a revenue, right? Okay. We go into this again and again. You don't have to catch it on the first time. That's the good thing, But the main thing is that you kind of get a good grasp of the kind of things that are on this list. And this is basically what's on the, these are the main things that are on the balance sheet. Now let's think about stockholders' equity. Now in Principles 1, we mainly talked about owner's equity. And this would be for a sole proprietorship, right? But what we're talking about more in intermediate is stockholders' equity. And that means we have a corporation. Stockholders, meaning the people that own stock in the corporation, okay? So since we have a corporation, which is like a more formal type of business, then we have stock. All right, so now I've given you all a bunch of clues as to what might be over here in stockholders' equity. What kind of things are found on the balance sheet under stockholders' equity? You have one, right? Stock. Okay. All right. That was a good clue I gave, right? All right. What kind of stock might it be? Common stock. We could have common stock, or we could have, no, treasury stock, but we don't really deal with that too much, to be honest, in this chapter. But I'm glad you pulled that out of the air. That was, you're looking at the most unusual thing. We have another kind of stock, though, preferred stock. And it might be a good idea to think about the difference in common and preferred stock. Doesn't it sound like the common stock's not quite as good as the preferred stock, right? Okay, but why? Why is it not quite as good? Well, the common stockholders are second in line if the company goes bankrupt. The preferred stockholders are going to get something first, okay? So if things go kaplooey, the preferred stockholders are higher in line to get any assets that are left over. Well, that's not such a great benefit, to be honest, because if the company goes bankrupt, chances are there's nothing left for anybody, any of the stockholders. So that's not as good. Now, what's the other thing? Preferred stockholders are first in line for dividends. So if there's not enough money to give dividends to everybody, for sure the preferred stockholders get it before the common stockholders do. So what they have is a guarantee of dividends, and it's usually like a percentage. So like maybe 5% dividends are guaranteed before the common stockholders get anything. That's really basically the difference in common and preferred. And so there's a lot of ins and outs with that. But that's enough for now. We have two types of stock, common and preferred. Is that the end? That's all that's on this? Dividends, okay. Dividends, yeah. Well, dividends, this is dividends associated. We're going to come back to that one. Retained earnings. There you go. Okay, so retained earnings. This is the most complicated thing on this whole list. retained earnings. And this is the hard one to understand, and so that we're going to spend a second on that. Let's see if we've got everything else on the list. Okay, so that's about everything. What you do on the balance sheet is you add up all of your assets and get a total assets, and you add up all your liabilities and get a total liabilities, and then you add up all your stockholders' equity, and the total of your assets equals the total of your liabilities and the total of your stockholders' equity added together, right? This makes sense, right? Okay, so there are 4 kinds of financial statements. 4 kinds of financial statements. We've just talked about the balance sheet. And anybody want to go with another kind? The income statement. Okay, so let's just make a list of the 4 kinds of financial statements. We have the balance sheet, the income statement, the statement of retained earnings, and the statement of cash flows. Okay, so these are the 4 kinds of financial statements. All right, we've gone over the balance sheet. We are also going to go over the income statement. But before we get to that, I want to think about the statement of retained earnings, okay? Because, why is that? Because we've just talked about retained earnings. So before we leave that, I want to think about what goes on the statement of retained earnings. Okay, and kind of the way to do that, the statement of retained earnings is on page 109, okay? So you can look at how the statement of retained earnings is set up on page 109 when you get a chance. But basically, retained earnings is equal to the beginning balance, okay? The beginning balance in retained earnings. In other words, the balance at the beginning of the year, okay? And then, what is retained earnings anyway, before we go into all of this? What is retained earnings? It's the accumulated profits of the company, okay? The profits of the company that have accumulated but not paid out to shareholders. The profits of the company that have accumulated and not been paid out to shareholders. Okay, so what do I mean by accumulated profits? What's our thing that we call the profits? What? Kind of. What financial statement do we find the profits of the company? On the income statement, we have, at the bottom of the income statement, we have something called net income. Right, okay. So we're going to, this net income for this year, so we're going to take the retained earnings from all the other year, the beginning of the year, we're going to add in this year's net income from the income statement, right? Okay, so what was our definition of retained earnings? It's the accumulated profits of the company that have not been paid out to the shareholders, right? So what are we going to subtract here? Dividends, okay. Okay, so that's all it is, really. I mean, in the simplest form. There's a little bit more to it than that, but in the simplest form, it's the beginning balance plus net income minus dividends equals the ending balance of retained earnings, okay? Now, your life will just be like tons easier if you kind of memorize this whole format, you know? If you know how to calculate retained earnings, then your life is going to be easier. Now, why is that? Because when you do financial statements, that when you do these financial statements, you're going to do the income statement first, okay? You're going to do the income statement first so that you can get the net income that needs to go into this one, the statement of retained earnings, and you're going to do the statement of retained earnings next, And then you'll have the information to do the balance sheet, right? Because you need the balance in retained earnings to do the balance sheet. Okay, so we're going to have a chance to do, a set of financial statements and do all this. Now, what gets people all twisted up is coming up with this retained earnings number, because we have to do these adding and subtractings and we have to figure out what the balance in retained earnings is. The company doesn't tell us the ending balance in retained earnings really on the trial balance. On the trial balance, what's the balance in retained earnings? The beginning balance. If you look at a company's trial balance, the balance that they have for cash is the ending balance at the end of the year. The balance for prepaid expenses is the ending balance. For stock is the ending balance, but the balance for retained earnings is the beginning balance. So this beginning balance is the amount that's on the trial balance. And this ending balance is the amount that goes on the balance sheet. Okay, so now what have we done? We've kind of gone over the balance sheet accounts and the statement of the things that go into retained earnings and the things that go on the statement of retained earnings. And now the other thing that we want to talk about is the income statement, okay? You might say, well, we've kind of gone over this in a weird way, we should do the income statement first. But I think this accounting equation sets us up now to do the income statement. All right, so now we're going to do the expanded accounting equation. And we're just going to add some stuff over here to the right for the expanded accounting equation. And again, that is on page 87, the expanded accounting equation. Okay, so what things do we want to add over to the right? We want to add the things that show up, in here, okay? Meaning net income and dividends, okay? Now, net income is made up of two parts, right? So let's just kind of think about that. Oh, that's maybe not a good place to write that. Okay, let's say we're doing an income statement. What does our income statement look like? Revenues and expenses. What do we do to that? To subtract expenses to get net income, right? That's what our income statement looks like. Revenues minus expenses equals net income. And what do we use net income for? We need it for retained earnings, right? Okay. So the idea that I'm trying to get across here is that revenues and expenses at the end of the year are folded back into retained earnings, right? Do you know what I mean? Like at the end of the year, you're going to close your books. Are y'all recalling this? You close all the income statement accounts, and all of that, this ending balance here, after you've closed all the income statement accounts, is going to be the beginning balance in retained earnings the next year, okay? So the income statement accounts start out with a zero balance at the beginning of every year. Okay, so if we're going to do the accounting equation right here, we want to add revenues and expenses right here to this equation. Now the key is, I didn't put any signs up there, right? Because, just thinking about what they should be, which sign should we have here? Revenues are added to stockholders' equity, right? They're added to stockholders' equity in this whole thing, plus net income, plus revenues, minus expenses. This is our net income formula. revenues minus expenses. So revenues are good things for net income, right? They're added to net income. So they're added to stockholders' equity and expenses are subtracted. This is the, in the expanded equation. So revenues have the same type balance as stockholders' equity. They have a credit balance because they're added to stockholders' equity. And expenses have a debit balance. This is where it gets fuzzy for some folks, Do y'all have this in your, you're not really worried about it right now. I know maybe you didn't worry about it all summer long. What has a debit balance and what has a credit balance, right? Am I right? Yeah? Okay. So maybe this one is the one that's, a little bit fuzzy. Revenues have a credit balance. Expenses have a debit balance. Okay. And we're going to go over, maybe you'll just take that for granted right now, and as we go through journal entries and stuff, this will make sense.
It seems like that one should be the other way around.
Right. Right. I mean, people, that one just seems to not make any sense. All right. But now the other part of making up retained earnings besides net income is what else do we have to worry about? In the restatement of retained earnings, there's something else that we need to add up here to our expanded equation, and that's this dividends right here. Right? So dividends are subtracted. Okay? So meaning they have a debit balance. Okay, so in summary, let's just kind of cut to the chase of debits and credits, okay? So debits mean left, credits mean right. What things have debit balances? Your assets. Expenses, and okay, so those three things. And really, dividends is the weird thing. You don't have to think about that much. It's really just the assets and expenses that have debit balances, right? The assets and the expenses. Okay. So those are the ones to remember, to mainly remember, the assets and the expenses. And you've got the assets part of it, right? And the other kind of interesting thing is the expenses and the dividends are way over here on the end, and they're the ones subtracted from retained earnings, right here. Expenses and dividends are subtracted from retained earnings, opposite of stockholders' equity, right? So what things have credit balances? Credit means right. And what things have credit balances? We have liabilities. And what else? Revenues. And stockholders' equity. Right? Okay, so those are the things with credit balances. And all of the little things on the list, on the list here, now by looking at this, you kind of know, okay, does accounts payable have a debit or a credit balance? A credit balance. Think of it as to what kind of account it is and where it falls. It's on this right side of the accounting equation on the balance sheet. It's on the right side. Okay, so now maybe we can list some revenues. And an income statement is on page 109 also. So what is our main kind of revenue? If I sell shoes, what do we call that? Sales revenue. Yeah, we do have rent revenue. Yeah. What if I am an accounting firm and I do accounting work? What do we call that? Not sales revenue, but service revenue. Yeah. Okay. So service revenue. Okay, so that's a bunch of different kinds of revenues, enough to kind of get us started, right? Now, as far as some expenses, well, there are all kinds of expenses. Any kind of expenses y'all want to shout out? Okay, administrative, wages, rent expenses. Okay, good. We got a bunch of them. Now, there's one that people don't name a lot. If I sell shoes, right? What's one big expense associated with selling the shoes? Okay, cost of goods sold is something that people seem to be confused about what it is. What is cost of goods sold? That is the cost of the shoes themselves, right? Is that an expense to you? Yes. Right? Does this make sense? That for a while, let's say you make your own shoes. You're a factory that makes shoes. And as you're making the shoes, you know, the shoes are in inventory. We have raw materials inventory. We have work in process inventory. And then we have finished goods inventory. All those are inventory accounts right here on the balance sheet, right? As you're making the shoes. But then when you sell the shoes and you recognize the revenue from the shoes, you're also going to recognize the expense associated with the shoes, because you're going to match your revenues and your expenses. At the same time you recognize the revenue, you're going to recognize the expense. And the expense of making the shoes or buying the shoes, whichever one, is called cost of goods sold. The cost of the goods, the shoes, that you just sold is called cost of goods sold, okay? All right, so now we have some revenues and expenses, and there's just tons of expenses. I mean, no need to list a whole pile of them, but I mean, kind of one weird thing, you know, you have to be careful about is we have rent expense and rent revenue, and we also could have rent payable, right? We could have a rent payable. So, you know, the word rent doesn't really do that much for us, right, as far as to tell us that much about the account. It's the expense or the payable or the revenue that kind of helps us out, or the context of the situation where we know what kind of rent we're talking about, okay? As a matter of fact, we also could have prepaid rent. Prepaid rent. Now we have rent just everywhere, right? In every different kind of account. So what's the difference in those? Prepaid rent, rent revenue, rent expense, etc. What do you think y'all could come up with the difference in all of those, guys? The debits and the credits, but also like in the whole scheme of things. Let's have an example of prepaid rent. Maybe y'all don't do this. Have you ever paid 6 months rent in advance? Anybody ever paid 6 months rent in advance? Sometimes businesses do this though, right? They pay 6 months rent in advance. Now, so what do we call that? Prepaid rent. Because that's an asset that they have now. Prepaid is an asset. This is an asset that they have. They have a place to stay for the next 6 months. That's an asset, right? And then as they stay there, month after month, they're going to move it over to rent expense. We're not going to expense it until we use up part of the asset. And every month, we're going to charge some to expense. Okay, so what is rent payable? This is when you're behind in your rent and you owe rent. It's kind of the opposite of paying in advance. It's paying it in arrears. You know, this is the rent that you owe that's in arrears. Okay, and so what is rent revenue? That's you're the guy renting the building and people are paying you rent and you're getting the revenue. Okay? What's that? Yeah, that's right. And then rent expense is your, when you're renting a place and you expense rent for each month. Okay? So how is that so far? Yep.
Where do taxes fit in?
What kind of taxes?
With this, I don't know. Like sales tax, I guess.
Sales tax. Okay. Sales tax that you pay or sales tax that you collect and need to remit back. So it's kind of like rent. There can be a lot of different kind of sales taxes. So sales tax, if you're the shoe guy and you're collecting sales tax.
I guess. I mean, that's
Okay.
sales tax, income tax. Income tax just.
Okay, all right, let's do income tax. That's a little bit cleaner. When you calculate your net income, you're going to calculate income tax expense on this. So like you're maybe going to multiply it by 15% and come up with an income tax expense, right? So where does income tax expense go? It's an expense on the income statement, right? Income tax expense. But if you pay it right away, fine and dandy, but if you don't pay it right away, you're going to have an income tax payable. Do you see what I mean? Okay, but then let's say you overpay your income tax. Well, what crazy person would do that? But sometimes the income tax is overpaid, like if you make a prepayment and now the government owes you something back, what do we call that? That's an income tax receivable, which is an asset. So you see what I mean? It's kind of one of those things where, depending on the situation. And it's the same thing with sales tax. Like, if you pay sales tax included on when you buy something, like if you buy a dress and you pay sales tax on it, that cost is included in the cost of the dress, right? But if you're a company and you sell shoes and you charge people sales tax, what's happening with that? You're saving that sales tax to remit it back to the government later, and so you owe the government for that sales tax, so that's called a sales tax payable. When you collect it, you don't recognize revenue. You put it in a payable account to pay it to the government later. Okay? So, yeah, so we could have income tax expense, prepaid income tax is payable. We could have all those different things. All right, any other questions about this part? So how blown away are you guys from this?
A lot of it is from the earlier. It's just I had to kind of refresh.
Right. Thinking about different stuff all summer long. Or
Counting one principles was very interesting.
That's right, yeah. And for a lot of folks, some people it's been 10 years, or 5 years. And imagine how distant that is for them when it's been so long. But
So is intermediate accounting too? Is that kind of like accounting?
Oh, okay, so let me tell you what we're going to do in Intermediate 1, okay? This will be interesting. What are we going to do? The first 2 chapters of Intermediate are kind of like philosophical, and there's not a number to be found. It's more like under what circumstances do we recognize revenue? Under what circumstances do we recognize an expense? What does being conservative mean in accounting? There's all of these accounting principles that are going to help you for the rest of your accounting lives if you know these kind of principles. They'll help you decide what to do in different situations because it's nearly not ever as cut and dried as maybe some of these problems kind of tend to make you think. Okay, so that's and the history of modern accounting, let's say, or the accounting rules like FASB and the PCAOB and stuff like that, okay? I'm just throwing out acronyms. Maybe y'all don't, maybe those don't mean anything, right? So chapter 1 has a lot of acronyms like that. Okay, chapter 3 is a review of principles 1, like I said, and it's a lot of this kind of stuff, but the other major thing in chapter 3 is how to make adjusting entries. First, we have to learn how to make entries, which I'm sure you knew at one time, right? How to make journal entries. But we're also, another main thing in chapter 3, in addition to this stuff that we just went over, is how to make adjusting entries, and then also how to do financial statements. So those are the 3 main things I want you to know in chapter 3. The accounts and where they fit in, how to do financial statements, how to make adjusting entries. That's a lot though, right? You spent a whole semester learning this stuff. Okay, then chapter 4 starts with the income statement. So in chapter 4, we're going to dive deep into the income statement. But it's not going to be our old friendly income statement, revenues minus expenses. There's going to be a whole lot of things added into it, and it's going to be way more complicated. Stuff that you haven't learned before, okay? Then chapter 5 is going to be the balance sheet, which is pretty much your old friendly balance sheet, but we're going to learn pretty much every account that can go on the balance, a lot of different accounts, and we're going to see whether they're current assets or long-term assets. You know, we're going to classify the balance sheet into different groups, the things on the balance sheet, okay? And also in chapter 5, we're going to do a statement of cash flows. So those are the 2 main takeaways in chapter 5, is the balance sheet and the statement of cash flows. So you're going to need to know how to do a statement of cash flows. Have y'all ever done that before? Statement of cash flows. So yes? Yeah? Half yes? And
We didn't spend a long time.
but you did one. Okay. All right. So maybe half yes, half no. All right. And then that's chapter 5. Chapter 6 is present value and future value and annuities and stuff like that. So y'all maybe will have this in finance or have had this in finance, but that's a whole chapter full of that. And then chapter 7 starts with cash and accounts receivable. Now, starting with chapter 7, what we're going to do is go down the balance sheet in order. What's the thing at the top of the balance sheet? Cash. Usually the next thing, accounts receivable. They're listed in the order of how current they are. So we're going to march down the balance sheet. The next thing we're going to study is in chapter 8, inventory. And then chapter 9 is also inventory, and then later on in intermediate 2, you go into fixed assets, other kind of assets, and then you go to the liability side of the balance sheet and go all the way down it. And then in intermediate 3, this is the very torturous class where you learn a lot of strange accounting rules, like for unusual situations like leases and pensions, and then there's a whole statement of cash flows chapter, a whole chapter on it. So all of these things together comprise like one whole section of the CPA exam. So the stuff that we learn here directly affects it's directly taken from the things that are on the CPA exam, okay? So like later on, I'm just going to assume that you guys are going to take the CPA exam or something like it, okay? If you want to be like a professional accountant, maybe you'll take the CMA exam or the CPA exam or something like that, and you'll need to know these things in detail, you know, for the CPA exam. So you can just rest assured that this stuff that we're studying is the kind of stuff that's on the CPA exam, okay? So, and all the stuff in the intermediate books, this book right here is like the most popular intermediate book, like by far. It's something like 70% of the people use it or something. So it's very popular. It's the kind of stuff that's in the CPA exam, and so that's what intermediate 1, 2, and 3 is about. Okay? Any other questions?